So I'd just like to give you an introduction, if you don't know us already, to Impax Asset Management Group, which is a company I founded back in 1998. And the slides that I've got for you are the results for our full financial year till the end of September, just gone. So we are an investment manager with a particular investment idea. We call the transition to a more sustainable economy, which, as I'll explain in a moment, is an opportunity to make great returns from companies that are growing rapidly in transition around energy and other sectors. So we have nearly a quarter of a century of experience of doing this sort of work, and today we're managing money in 3 asset classes: listed equities, listed fixed income, and in private markets. And with nearly $50 billion under management, we've got a very broadly diversified client base, so nearly 80% of our clients come from outside the UK. And our business idea or business plan is to scale up to or towards $100 billion over the next few years as these opportunities provide more scope to deploy capital. So the transition to a more sustainable economy essentially is based on the idea that given a finite planet and concerns about rising levels of pollution and health impacts, as well as global climate change, there are some transitions underway. For example, the switch to clean energy, the adoption of more efficient materials, the move to electrification of the drivetrain for transportation, and also efficiency improvements in healthcare and financials, to name just a couple, that are being shaped also by technology, by regulation, and by changing consumer demand. So the sectoral transformations in which Impax has expertise are providing high rates of growth and quite often opportunities for mispriced securities to come along for us to buy. So the heart of our investment idea is this approach to, if you like, industrial revolutions. Now, what we do, of course, does resonate quite nicely with investors or asset owners who are looking for exposure to ESG or have some other value or ethical type idea. And so our appeal is both to mainstream capitalist investors and to values or ethically driven investors. We run a number of products which are broadly shown here. So our environmental markets range is a thematic set of products, for example, water fund, a food fund, and then our more broadly based or core products in the sustainability category, as we so call it, are both in actively managed equities and in fixed income. Our distribution has been built up over more than 2 decades. So this map of the world shows that we have quite extensive partnerships in North America, where we've been managing money for clients since 2008. Europe is definitely our core home market, although 40% of our staff are overseas. Most of those are in the US. And then we've got an increasing footprint in the Asia Pacific region as well. So in the 12 months to the end of September, we reported positive net inflows into our business, which was unusual for asset managers. And although markets were a headwind, we had a pretty small drop in assets under management over the year and actually have recovered very nicely in the first 2 months of our new financial year, so October and November, to £39.2 billion, which is around $47 billion. So despite the challenging market backdrop, we do think that our investments thesis is very strong and intact. The financial numbers for the year shown here, but at a glance in the dark blue bars, which is a year just gone, compared to the previous 12 months in the mid blue bars, you can see that revenue went up, profit went up, and on the bottom right, you can see a 34% increase in the dividend per share. We've also announced that our CFO of the past 14 years, Charlie Ridge, will be retiring in a few weeks, and Karen Coburn is joining us, having had a long and very successful career in banking and insurance. So she's becoming the CFO from January. During the year, we also had a strong first half and second half. It wasn't just a first half performance. So what this chart shows is that flows in the second half of the year, the 6 months to the end of September, were still positive, even though market movements were more negative than they were in the first half. So it has been a difficult year for investment managers, and that's obviously because of the macroeconomic situation, concerns about inflation, about high interest rates, and exacerbation of problems with investment sentiment, investor sentiment, given the tragic war in Eastern Europe. So lots of challenges for investment managers. There's been a switch or a rotation into value, and therefore growth-oriented investors, which Impax would be one, have had to be very careful, looking even more carefully for growth at a reasonable price, which is Impax's investment style. At the same time, however, then the weather-related disasters around the world have really focused the minds of policymakers in the need to both adapt to increased problems with the weather, but also crucially to mitigate further climate change by switching to clean energy across the board and improve efficiency with which resources are used. So in that sense, there has been a secular tailwind this year for investor interest in what Impax does. So what we call the transition to a more sustainable economy has continued to strengthen this year, with policy announcements, particularly the US Inflation Reduction Act, being at the heart of improved investment sentiment around many of the stocks that we own. And we see that trend will continue to build over the next few years. So in that sense, Impax, being one of the world's leaders in with the investment expertise in this space, continues to be exceptionally well positioned, we believe, with a very strong client base and significant scope for growth. A couple of slides now on how our assets under management are broken down. So in the blue part of the slides, you can see the thematic element of our fund range, environmental markets, and then the orange is the sustainability lens or more core parts. So we are around sort of 64% AUM in the thematic area, but that has been reduced slightly relative to an increase in the core part. And that is a symptom of the fact that this year investors have been looking for less differentiated, less sort of risky, if you like, investment strategies and going more for core products. Our client base is well diversified by channel as well. So we run a significant number of white label funds where Impax has got a lower profile alongside our own funds and accounts with Impax on the brand name, if you like. And then our distribution partnership with BNP Paribas, which is actually our largest investor with 14% of our equity, is significant, but actually declining slowly as a percentage of the total, as is shown particularly by the mid bar on the right-hand side of the chart. And then on this chart, particularly on the left, you can see that the EMEA region ex-UK is half our assets under management, with the UK being 21% and North America being a very healthy and growing 27%. Flows for the 12 months also told quite an interesting story. So in the UK, we have a very successful, approximately 5-year-old relationship with St James's Place, which was our largest single source of new money for the 12 months just reported. And then on the right, you can see that BNP Paribas was slightly negative, while our partnerships with other groups across the European region were positive. And then on this chart on the left, you can see that North America, I'm looking at the dark blue bars again, was positive in terms of flows across all channels. And in the Asia Pacific region, we also saw positive flows and actually accelerating flows, which is very encouraging. The next two charts are a little bit busy, but show the investment performance. So here there are 5 sections for our sustainability lens or core products. The top 3 are equity, and the bottom 2 on the page are fixed income. So there's 1-year, 3-year, and 5-year numbers, dark blue versus the benchmark in mid blue. So just eyeballing these numbers, you can see that over 3 and 5 years, we continue to be outperforming our benchmarks in most products. Over 1 year to the end of September, slightly behind, but actually in October and November had a nice reversal of that negative performance and pretty much in line for many of these strategies. In the environmental market space, which is, if you like, more risky, more differentiated, higher tracking error, as investment managers refer to, then the 1-year performance is actually weaker to the end of September, but the bounce back has been stronger. So overall, good investment performance numbers over what clients really care about, which is 3 years and 5 years, and the 1 year has been really a explanation or a manifestation rather of what these products do for investors, which is they don't outperform in all market environments, but with the secular tailwinds that I was describing around our thesis, then we think these sorts of conditions we've seen in 2022 are unlikely to persist for a long period of time. We've also been busy developing new products, so creating new fund wrappers and vehicles for our current clients and new clients wanting to invest in the same strategies as we're currently running to invest in. Point two is that we've just launched a new product, so listed infrastructure using our own in-house team. And thirdly, we're continuing to look in the fixed income and private market space for additional teams or boutique fund management groups that we might be able to bring onto our platform. We last made an acquisition back in 2018 when we bought a business in the US, which has given us a very strong acceleration of both distribution and investment management capabilities over there. Our clients, by and large, are institutional and sophisticated investors or intermediaries, and therefore they are also interested in some of the non-financial work that we do, which is in following areas on this slide and the next one. So policy work helps inform our investment ideas, but also the advocacy that we do to help shape new regulations is highly prized by many of our clients. We are continuing to invest in research around topics like biodiversity and climate change risk. And we're active members of many of the international groups around these sustainable development topics. And then in the stewardship space, we continue to be focused on quality companies, but are very keen to lead in and build relationships with boards and management teams and be helpful around topics such as governance, shareholder rights, and compensation. So people remain, of course, at the heart of our business, and we've had very significant headcount growth this year, so 26% increase in staff numbers, with the breakdown shown on the right-hand side of this page. And you can see there the numbers that we've got in the US, which I think is a key standout for a UK domiciled manager to have such a large percentage of staff based over in the world's largest market in terms of capital availability. We've opened a Manhattan office this year, and we are shortly going to be opening a small client service office in Tokyo. And as our business grows and continues to scale towards 300 people and beyond, then we're continuing to invest in compliance and risk, which are right at the heart of the risk management, right at the heart of the way that investment management is regulated and needs to report. And IT is essentially an incremental area for investment, but we're seeing quite significant synergies from investments that we've made in IT over the last 3 or 4 years. So just wrapping up, and then should be time for some questions. What hopefully these slides and a quick canter through have illustrated is the fact that Impax, with its nearly 25-year history, is in a very interesting part of the market. We are tapping into a secular transformation of much of the economy, with that transformation, that change being driven by quite complex factors which lend themselves to specialist investment management expertise. With nearly 80 or around 80 investment professionals, and those investment professionals together owning about 20% of our business, together with our other key staff, then we think we've got a very nicely aligned partnership, if you like, with external shareholders providing us with capital, and those investment managers have been delivering some excellent numbers. Meanwhile, we have a fairly unusual, if not unique, distribution platform for a mid-sized boutique with exceptionally well-resourced teams in the US and Europe, and partnerships out in the Asia-Pacific region, which we think will underpin our growth potential, and an ability with our current product range to be able to double the size of the business in terms of assets under management and in principal revenue, while such a doubling would not require a proportionate increase in headcount. So we ought to be able to manage that sort of increase in business with around 30% increase in headcount. If we do that successfully, then there's no reason why we shouldn't be able to continue to build the dividend track record and improve the return for shareholders. So let me pause there. Hopefully there's some questions, and we can carry on a more focused conversation.
Ian, thank you very much indeed. Questions about the dividend to start with. You mentioned there again that it's a rising dividend. What is the dividend actually in pence, and when do you pay it?
Oh, that's a good question. So that's back on the earlier slide. Let me see if I can go back to give you the exact number. So yes, sorry, I'm squinting, 27p, just over 27p. So that is paid, I believe, in May, and then the interim dividend is 2 or 3 months later than that. So apologies if I haven't quite got those dates right, but it's two dividends a year. You can see that the interim dividend in the lighter blue is much smaller, which we sort of have been paying for 5 or 6 years or so. And the much larger final year dividend is the one that's based on the numbers that we've just reported.
And following that, I had a question about the shareholders. Are people now owning Impax as a dividend investment? Are you starting to get the like David before, so the income funds owning the share?
So the investors who we're talking to on a regular basis are quite a lot of UK small cap managers. My understanding is that what they're looking for is a growth stocks. As an AIM company, of course, we're attractive for IHT-oriented investors as well, in principle. So I wouldn't say that we're we're consciously talking to dividend-oriented investors. I'm interested to get David's perspective at some point. But of course, with a very nice and solid progressive dividend history now going back well over a decade, I think we are certainly committed to paying a progressive dividend. Obviously, the share price has been quite volatile over the last 12 months, and so the yield's been moving around quite significantly.
Is there a question? Do you know what the yield translates? What that translates to as a yield?
Well, I mean, the share price is around £7.50 plus or minus, so that's probably about 3% yield at the moment, if I'm doing my maths correctly.
Questions about growth then. The move from, you mentioned an ambition to get to 100 billion AUM. The challenges from 50 to 100, what are the main challenges, and are they different to the challenges you faced from 0 to 50?
Yeah, so there's a dollar numbers just to make sure there's no confusion. So we're about $47 billion today. So to get to $100 billion, then in principle we ought to be able to get there just by persuading our current clients to double the amount of money in the funds and accounts that we run for them today, which number around 80 or so. Now in the real world that doesn't work, so we are continuing to pitch our services to new clients in the 3 major geographies. So it's quite difficult to forecast exactly what the balance is going to be as we grow between money coming to existing funds like the St James's Place Fund, for example, or the BNP Paribas funds or our own funds, versus money coming to new funds and accounts. Now, new funds and accounts obviously require more of a sales exercise and need servicing, both from a client's communication perspective, but also from a sort of back and middle office and legal and compliance perspective. So what we're effectively steering the market towards is to say that if we do get to $100 billion, that we will be somewhere between 350 and 400 staff, we think, compared to today's 285. The other challenges around growth, of course, are making sure that the wheels stay on, the compliance, risk management, and the back and middle office fulfillment are solid, and making sure that we keep costs down on IT. Crucially, we do have a very strict and sort of well-established approach to variable remuneration, i.e. bonuses, so that we aim to cap variable remuneration at 45% of relevant profits pre-bonus. And this year we paid out, for example, about 40% as we did last year. So that's usually a key determinant of asset manager profitability.
You mentioned the last acquisition was the US group to aid distribution into the States. If you were to make further acquisitions, would it be mostly for distribution? Would that be the aim? And if so, are there any territories that you think that you'd want to strengthen in?
Actually, distribution would probably not be an area that we'd make acquisitions in. We'd prefer either to hire our own people or to team up with partners, like we did in Australia a couple of years ago with a group called Fidante Partners, which is part of Challenger Insurance Group. So acquisitions, if we did make them, would be almost exclusively in the investment management area to bring on board additional capability, for example, in the private markets or fixed income space. Now, if we bought a business, we'd only buy that business if it had assets under management, which we'd be able to use as a sort of foundation for further growth. So that's the idea of buying a boutique, which essentially is what we did with the Impax acquisition back in 2018, for which the consideration was $52.5 million.
And then if you were to, the valuations for those sorts of companies, as a rule, Impax aside, but for asset managers, are valuations low, high at the moment? Is it an unloved space?
So I think in general, valuations are suppressed by market sentiment and in some managers' cases because of poor flows, so negative flows. I think given the very specific requirements that Impax has, that we would be looking for something that was unusual and therefore there wouldn't necessarily be a strong consensus or an easy consensus around what the valuation would be. But we, for example, paid around 8.5 times run rate EBITDA for the Impax acquisition, and we'd certainly be looking to pay in that sort of 5 to 10 times run rate EBITDA range for acquisitions, unless there was some extraordinary reason for paying more.
And final question, Ian. Question is, if you can comment, can you comment on your share price volatility over the past year?
Well, the things I can say are that there's been no material change in the sort of makeup of our shareholder register. So BNP Paribas still there, management's still there with about the same level of shares. Small cap managers that backers that are declared, including Lion Trust, Henderson, BlackRock, are still all there, and I think they may have been adjusting their positions a little bit, but not materially. So the derating appears to have just been the same derating that many stocks across the market have experienced. Asset managers have been sold off quite strongly because they do tend to be seen, understandably, as sort of geared plays on market sentiment. So yes, I mean, at one stage our share price was down around 60% compared to the peak, but it has recovered quite materially. And so yes, I think that's probably all I can say. There's definitely, from our vantage point, there's no change in fundamentals or general positive sentiment towards the company.
Well, that's us then. Thank you very much indeed for presenting. Thank you for joining us this evening.
Great, thank you very much.